Welcome to July's market review. Today we will be going through three main points. First of all, we will be looking at July's market performance. Next, we will go into the first 3 trading days of August, trying to understand what happened during these days that led to a sell-off in the stock market. Subsequently, we will go through US equity landscape as a final series of major economies' stock market. In July, we see a stock market rally, and this is thanks to cooling inflation as well as a relatively weak employment data. And as a result, this actually caused a higher probability of Federal Reserve rate cut expected to be more than once. And in fact, because of this, small size stocks actually outperform their larger counterparts. And this means that dimensional stocks outperformed the market indexes in July. On that said, following the end of July and the start of first 3 days of August trading days, there was a market sell-off. This was actually caused by mainly by a technical issue, which is that the carry trade has been unwinding. And we'll go through that slightly deeper to understand what is going on. And finally, of course, as I mentioned just now, the US equity landscape, which gave us plenty of lessons on why we should be staying invested and aim for the long-term returns and not to do any market timing. Now, without further delay, let's go into July's performance. As I mentioned just now, July's performance has been relatively strong, and we can see that the increase in probability of a Federal Reserve rate cut actually led to a rally that mainly benefited the developed market. And as you can see, the MSCI World Index, which tracks 99% of the developed world market index, is up by 2.27%. While S&P 500 index, which covers the US top 500 companies, is up 1.22%. Or comparatively, the MSCI emerging market only rise about 0.25%. And on the whole of the MSCI all country world, which has roughly about 90% developed market and 10% emerging market, is up about 2.06%. Now, of course, the fall in discount rate means that yield is also falling at the same time, and what we are seeing is that the fall in yields actually led to a rise in price in the Bloomberg Global Aggregate Bond Index, which is up almost 2%. Now, going into the dimensional funds performance, as I mentioned just now, small cap stocks has been outperforming the large cap stocks in July, and as a result, dimensional global targeted value, which mainly have small size stocks and small and value stocks, went up about 7.55%, while the while the dimensional global core equity fund is up by 3.25%, and dimensional world equity fund is up by 3.28%. Now, comparatively, dimensional emerging markets, large cap core, although it's in negative territory, it is about in line with the MSCI emerging market index. Okay. Now, going into the dimensional global core fixed income, it is up about 2.02% thanks to, again, the fall in yield. However, in the first 3 trading days of August, we see a sharp sell-off in the stock market. What happened? Well, there is a carry trade unwind, and this was the main cause of that sell-off. What is a carry trade unwind? Well, it means that an investor will borrow in a lower interest rate country like Japan and then investing in a higher interest rate country like US. Right here we have an example. Assuming that the interest rate in Japan is about 0.4% and the investor is borrowing 10 million via the Japanese bank, and using that 10 million yen, they exchange it to US dollars. And using that US dollars, they invest in the US dollar money market, for example, at 5%. Now, earning 5% per annum and borrowing at the 0.4% would make them a 4.6% profit, assuming that interest rate doesn't change. Now, of course, this assumption might not hold true And in the event when Japan's interest rate actually go up, it means that their borrowing costs will go up. At the same time, Japan's exchange rate would also, Japan yen's valuation would also rise. And this means that the US dollar would weaken, and this would actually reduce the value of their profit. And in fact, this is exactly what happens. As you can see, the US dollar to Japan yen depreciate almost 9% from the first 3 weeks since August 5th of August. As a result, many investors who engage in these carry trade have to sell off their existing investments in the US, like stocks, bonds, and what I mentioned just now, the money market, and then use it to cover their losses via the yen. As a result, you can see that the dimensional funds and the market indexes fell more than 6%. And year to date now, we have dimensional world equity at 3.5%, dimensional global core equities year to date performance at 5%, emerging market large cap core 1.3%, global targeted value 1.15%, and the MSCI World 6.4%, MSCI emerging market at 1.1%. However, if investors actually decide to sell at this point due to the panic, they would miss a sharp rebound, which is what we are looking at. However, this is not the end of the story. The market saw a sharp rebound subsequently from 5th of August to 16th of August. And in fact, month to date, the MSCI World ETF actually in fact rose by 0.5%. So this serves as a reminder for investors that not to panic when there's high volatility and remain invested. In our final series of covering major equity landscape, this month we'll be looking at US equity landscape. Okay, first of all, the importance of US equity landscape. Within the MSCI World All Country World IMI Index, which covers 99% of the investable market in the world, US has a country weight of about 63%, while coming in second was Japan, which is only at 6%. This shows that US is the most important equity among all of the major economies' stock market, and hence it is the reason why we should understand the US equity landscape. I'll be running through US historical stock market performance starting from the COVID lockdown in the early 2020s, and the risks that I'll be covering which might impact the US equity stock market will be inflationary risks, high interest rate and government debt, as well as the US commercial real estate risks. Subsequently, we will also explore recent developments. For example, the first one would be how the upcoming US election would impact the risks that I just mentioned. And on top of that, there were concerns about high valuations, especially for the tech stocks, and whether these resemble a dot-com bubble bust in 2000. At the start of the COVID pandemic lockdown, there was a sharp sell-off as the market panicked that the lockdown might have a very huge adverse impact on the stock market. And this led to a sharp sell-off, as we can see from this March 2020. However, that being said, the market rebounded up by 16.3%. Why? Because there was a fiscal stimulus by the government, as well as the US Federal Reserve actually kept borrowing costs at almost zero. This actually benefited businesses as well as drive consumption high. And the year in 2020 actually ended in a return of 16.3%. In fact, if we look at the real G7's real GDP, Canada, France, Germany, Japan, United States, and Italy, US has the strongest rebound of all of them, and actually it was comparatively to the other G7 countries. However, that being said, inflation has started to rise in 2021. In fact, since since June 2021 up to December 2021, inflation actually rose about from 1.7% to 7%. And subsequently, it reached a peak in 2022 of 9%. This actually led to a high inflationary environment, not just in the US, but globally. Now, what is the implications of a rising inflation? First of all, rising inflation would have an erosion of purchasing power of family and households, and this would actually lead to a negative wealth effect, causing households to consume less and thereby negatively impacting business earnings. Of course, next we have increased costs because inflation usually would lead to a higher input cost, and this would actually eat up their earnings as well. Now finally, rising inflation would also reduce investment returns because as inflation rises, the real returns in investing in stock market would actually be lesser, and investors would see equities as a less attractive asset, and therefore will reduce capital inflow into the stock market. Continuing on timeline in the US stock market, in response to the rising inflationary risk, the Federal Reserve hiked interest rates sharply. And this caused borrowing costs for companies to rise sharply, as well as the debt servicing costs for US government to rise as well. That this means the high interest rate would imply that the valuation multiples for stocks will be reduced. This is due to the fact that the value of stocks is mainly derived from their future earning cash flow, and a higher borrowing cost would actually lead to a higher discount on their future cash flow, leading to a lower valuation on their stock prices. And this is especially true for growth stocks due to their higher future earnings. Now secondly, as I mentioned, the increase in interest rate meant increase in borrowing costs, and companies with significant debt will face further higher interest rate expenses, reducing their profitability and affecting their bottom line and therefore their stock prices. Okay, and finally, aggressive rate hikes can also cause economic slowdown, impacting corporate earnings and consequently stock prices. Now, going into the debt issue, the rising in interest rate would mean that the US government would require higher servicing costs for their existing debt, and this would mean that the investors might question the US government's ability to service these debts, and leading to higher market volatility and potential sell-off. Secondly, an interest rate hike would also lead to a credit rating downgrade, because this would mean that there's a potential that the government might not be able to address its debt ceiling issue, and this could impact investor sentiment, leading to a downgrade of the US credit rating and increased borrowing costs for the government and businesses. And finally, inflationary pressures. Rising debt can fuel inflation, which might force the Federal Reserve to increase interest rate, and this could create difficulties for the stock market as well due to a higher borrowing cost. 2023 was actually a surprise for many investors. Bloomberg economists by the late 2022 actually forecasted a 100% recession in the US economy by 2023. However, the S&P 500 actually saw a almost 20% return in the year of 2023. Now, what happened? As you can see in this real GDP growth, according to an analytical firm, the blue chip actually forecasted that the US real GDP growth would be about negative 0.1%. However, in 2023, actually real GDP growth was about almost 2%, which is a surprise. Now, this is due to a strong consumption growth in the household. Furthermore, the monetary tightening caused by the Federal Reserve rate hike to deal with the inflation actually caused the commercial real estate prices to fall even further, as they have to service a larger debt. And this, as you can see, across all the history of a monetary tightening, the commercial real estate prices actually fell by the most from 2022 to 2023. Now, what is the implication of this? First of all, as I mentioned, the diminishing demand for office spaces is driving down property values and increasing vacancy rates, and therefore affecting the health of commercial property owners. Now, secondly, this raises the risk of loan defaults as the value of collateral depreciate. Consequently, banks who provided the loans to these commercial property owners could see a rise in performing loans, reduced profitability, and potential stock prices decline. As a result, investors' confidence in these financial institutions may wane due to concerns over asset quality and loan loss provisions. Now, the final point, banks are likely to adopt a more cautious approach to commercial real estate lending, potentially reducing credit availability, and a prolonged downturn in commercial real estate could lead to a broader economic slowdown, which can be further challenging to banks and impacting their stock performance. On our next point, what does the upcoming US election mean for this risk? We will look at it on the different outcomes of the election and see what is the potential risk there is. Now, first of all, let's say that Democrat Party Kamala Harris wins the House and the majority in Senate. What is the inflation risk and impact on US equity market? Now, based on the policies, the impact could be that there will be continued increased government spending on social programs, infrastructure, and green energy initiatives. And these could potentially lead to higher inflation as increased demand and government expenditure. And however, these policies, of course, would stimulate growth and supporting equity markets in sectors like the renewable energy, infrastructure, and technology. However, the continuation of fiscal policies can potentially lead to higher debt levels. Then, of course, in higher debt levels would mean that the higher interest rate could increase the cost of servicing their national debt, leading to concerns about fiscal sustainability, fiscal sustainability. And equity markets might face pressure due to higher borrowing costs for companies, particularly those with significant debt. Going into the impact on US commercial real estate, there are policies for supporting urban development and green building initiative. These might provide some support to the commercial real estate. However, the challenges for reduced demand due to the work from home policies could continue to weigh on property values, and bank exposure to commercial real estate remains an issue. Okay, now if we look at scenario 2 when Trump wins the House, policies such as tax cuts, deregulations, and tariffs on imports. This may spur economic activity, but would lead to higher inflation. Tariffs could increase costs for consumers and businesses, again contributing to inflation. And equity market may benefit in the short term from tax cut, but long term face inflationary pressures. Next, we look at the impact on high interest rate and the US debt issue. Well, definitely there will always be policies to stimulate growth, potentially increasing national debt. And what this means is that similar to what happens when Kamala Harris wins the seat and the Senate, this would lead to higher debt servicing costs, and equity market may face volatility over US government's fiscal sustainability, and therefore higher costs for businesses as well. Going into the commercial real estate, there might be again some tax incentives for real estate development. Commercial real estate sector might see some alleviation, But again, the commercial real estate still remains and still have that ongoing issue of diminishing demand for their working space. Finally, if we look at the scenario 3 bipartisan government, where one party controls the House and the other the Senate, the inflationary risk might be more subdued because both parties might prevent extreme fiscal policies from being implemented, and therefore we might see a more balanced approach towards fiscal approaches. That being said, growth might be slower. What would be the impact on high interest rate and the US debt issue? Interest rate might rise more gradually, but the debt servicing cost compared to the previous two scenarios might be more manageable, and there could be a more predictable fiscal environment. Into the US real commercial estate, the issues remain the same as the previous two scenarios that I mentioned, which is that office space in commercial real estate continues to see reduced demand, and this is very difficult to be rectified. Since the 1940s, after the World War II ended, the stock market has been rising despite whichever party being the president. And this is important as investors need to understand that trying to time the market could result you in what we have seen in August, where you sell at the wrong time, or in 2023 where Bloomberg economists predicted that there is a 100% recession, but in fact the economy was very strong, resulting in a strong rebound for the market in 2023 as well. So the lesson to take away here is that it is important to stay invested, and that what matters most is that the fundamentals remains strong, which goes to our next point. Will the US mega stocks bring about a dot-com bubble burst due to their high valuation? Well, first of all, back in 2000, when the valuation was extremely high, the PE ratio, the US tech companies do not have a strong fundamental. Earnings has been relatively weak. However, if we look at what is going on in the earnings growth of the Magnificent Seven, we can see that all of them has been showing strong fundamentals. Apple has been growing by approximately 9% annually. Most of us has either using a Apple phone or know someone that uses an Apple phone. Microsoft, everyone is using Microsoft Office products, and Alphabet has been growing by roughly 14% since 2019 to 2024, and we can continue going on at each of these companies. For example, NVIDIA has seen an impressive earning growth of approximately 62%, which is one of the key reasons why there was a concern about the high valuation, because NVIDIA's stock has been rising quite sharply for the past year. That being said, this is supported by strong fundamentals. As I mentioned just now, the earnings growth has been approximately 62% per year for the past 5 years. So just to keep in mind for everyone, volatility is inevitable, and it is important to try not to get affected by the market headlines and stay invested. I'll now hand over to my colleague Seth, who will be going through the market debrief. Thank you.
Thanks, Choon Siong, for the market update. I'm Seth, a client advisor with Provident, and I'm going to go through the remaining slides. So market outlooks are like weather reports, right? We don't change our plans according to the weather that much. So likewise, we don't actually change our investment philosophy according to how the market moves. So we actually use market updates as a way to have some kind of mental preparation on what's going to happen in the short term, because it's useful for short-term planning. So perhaps you might have some funds that you feel that you need over the next year or so. You might want to take less risk on that. But for your long-term plans, right, nothing is going to change. I would just like to remind clients of our investment philosophy, which is we invest for the long term, and that's very important. But in the short term, of course, volatility may cause it to be very difficult for us to manage our emotions and stay invested. And therefore, right, at Provident, we believe that we need to help our clients stay invested, and we have a variety of methods to do so. The first would be the investment that we use. We need to put them into correct investments and correct instruments. And we use equities to give us the returns that we need in the long run. And we use bonds to smoothen out volatility because they are safer assets. And we also rebalance portfolios regularly to make sure that the risk we take are appropriate for our goals as well as our own risk appetite. In our wealth and financial planning process, we also make sure that we align our clients' need to take risk, ability to take risk, as well as their willingness to take risk in order to have a good investment experience. For retirees, we mitigate the volatility in the market using our Retire Well system to make sure that the funds they need to use is not subject to the volatility of the market, whereas their long-term funds can actually have the time horizon to give them the returns they need for their entire retirement period. Lastly, we also have the turbulence management plan where we actually update our clients what's going on in the market if markets were to experience sharp drawdowns so that they know what's happening and have the confidence to stay invested for the longer term. As we always say at Provident, right, we let the markets work for us, and the markets have traditionally rewarded long-term investors. So you can see small cap companies have given very great returns for investors who stay the course. And this is a historic performance of the past 100 years or so. And US large caps as well have done pretty well. And as you can see, right, as long as we stay invested for the long term, we can ride the ups and downs and get better returns for us to hedge against inflation. Lastly, we should focus on what we can control, and we can actually control things like having an investment plan that's catered for our risk tolerance. We can also structure portfolios according to the drivers of returns, meaning to say we invest in things that have economic contribution to society, and over time, right, we can expect an upward trend in the growth. We make sure we diversify globally so that we can get worldwide exposure for investment returns. And of course, when it comes to investments, right, there are some expenses that we can manage as well as the tax structure to reduce our costs. Last but not least, we need to make sure that we stay the course and remain disciplined when it comes to our long-term goals. Right? We invest for a specific reason, and if the reason is retirement, for example, 15 years away, right, it doesn't really matter what markets do in the short term, and we must make sure not to panic when markets are low. And of course, when markets are high, we shouldn't be too happy because we are not using the funds right now. So yeah, that is the end of our presentation, and I hope you stay the course as I mentioned and remain invested.